on your radar. MOVE. Get rid of the VIX, follow the move, because it's the credit markets where damage can truly be done. Going into the last crisis, we had $170 trillion of debt globally. Today, we have over $250 trillion of debt. A lot of it's toxic. I am watching more closely than anything. I've done more writing over the past year. I was in front of the Wall Street Journal. I was in front of Bloomberg. Even though I write for Bloomberg, I was in front of everybody in writing about BBB rated investment grade bonds. You must put investment grade in quotes. That is what I'm following the most closely. General Electric, I will remind you, was a BBB rated company. Its bonds traded like junk. This is the sector that has grown to be a $3 billion monster. $3 billion. Think about that. Where's the parallel? Oh, I don't know. Subprime mortgages circa 2007 peaked out at $3.2 trillion. The BBB segment of the investment grade bond market is now $3 trillion. It is larger than every other investment grade rated bond combined. Morgan Stanley did a recent analysis. I've got to agree with it. They think that we will see a third of this $3 trillion downgraded. They call them fallen angels. And I think we will see angels falling from the firmament in this next downturn, because credit rating agencies have actually done something remarkably similar to what they did during the last run-up, during the last credit boom. Their analysts, believe it or not, I mean, I hate to convey such shock, but their analysts have been strong-armed by management that's paid by the companies they rate to maintain their investment grade ratings, because if they're not maintained, then big institutions fiduciarily cannot hold these bonds. And so they have bent. And who will pay? That would be grandma and grandpa, because their local neighborhood broker has told them that it is an investment grade bond fund and you're going to be just fine. There is something worse. There is the leveraged loan market. And this came right out of the mouth of one of the high yield strategists at a credit rating firm a few years ago. Remember this the next time somebody tells you about the virtues of leveraged loans in a rising rate environment. Again, capital losses, capital losses. Leveraged loans are basically issued by companies that cannot access the junk bond market. They're junkier than junk. So what do? They go off to their friendly neighborhood investment banker and they syndicate a big junky loan. That market is bigger than the high yield bond market. That's another benchmark that we've seen in 2018. Follow leveraged loans, follow investment grade. There's a reason investment grade has been so much bloodier than high yield. It's with good reason. So if you don't have an account at Merrill Lynch, let's say, maybe you should get one. Open a money market fund. Get access to weekly fund flow reports, because they tend to be the first signal that you'll see is funds flowing in and out of any given asset class. And they're what I follow the most closely to see where investment grade, where any asset class for that matter, is headed. I think the most difficult question to answer in today's environment is, where do you put your money? How do you protect yourself? Again, this is a vestige of being a Fed insider for as long as I for as long as I was. And what we learn in downturns is the hard lessons of correlations. And unfortunately, asset classes tend to move in tandem when price discovery has been eradicated, when central banks prolong the business cycle artificially. So there really are so few places to hide, but I may as well share where I'm hiding. I have a lot of money in cash. It pays a lot these days. It actually pays more than inflation, so that's technically a lot. And it's an option for the first time in my investing career. Cash is an option for the first time. And believe it or not, I own a lot of short-dated municipal bonds. I like to say that there's no such thing as a Brexit. We weren't able to get rid of Puerto Rico. It was against the Constitution. But by the same token, we have a lot of states, municipalities that will have, they've got growing mushroom clouds over them. Chicago, Illinois, New Jersey, California. We will have municipal bonds that go belly up, and we will have serious pension crises in the years to come. But that being said, there are a lot of well-run states and municipalities. So I have found myself a great manager who doesn't buy funds at all, individual bonds that you do your true due diligence on. It's one of the last standing asset classes where you can truly do your homework and find out if you're going to get paid back your principal. Capital losses. Preserve your money. So I'm in very few places. I own a gold fund because if we've learned one thing from lower for longer and from overly intrusive central banks, it's that there is exactly one asset class on planet Earth that is negatively correlated to pretty much everything else when the peanut butter hits the fan, and that's gold. Am I a gold bug? Are we going back on the gold standard? No, we're not. It's not practical. But that being said, if you want to hedge your portfolio, it's a really good place to be. But if there's one irony I will leave you with, it's Janet Yellen. This is a woman who said that we'll never have another financial crisis in our lifetimes. She attributes this to the fact that the banking system in the United States is cleaner than it once was. Recapitalized, kumbaya, cue the birds and the butterflies. Just have them fly on screen. Can somebody tell her where the capital markets are? Can somebody tell her where the growth has happened? And once she appreciates that and the fact that under her leadership, the Fed prolonged an economic cycle beyond where it should have been and prevented companies from defaulting that should have defaulted, that her second statement that this is going to be a plain vanilla, shallow, not bad recession. It's just going to be another walk in the park, what we have coming up. Well, we've got to clean up the last cycle, which we never did clean up because QE prevented that. And we've got to do the next cycle that's even bigger. So will it be plain vanilla? Will it be short and shallow? I don't think so. But I am happy that Janet Yellen is on the record saying that we would have a kind recession and that we would never have another financial crisis.